US inflation has hit a 30-year high. Can the Federal Reserve do anything to get it under control? Or do they even want to get it under control? For a different take on the inflation story, I'm chatting with Kevin Muir of the macrotourist.com, who thinks that history may actually end up being kind to Jerome Powell. To find out why, watch this episode of GoldCore TV. And remember, as always, if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to GoldCore TV and hit your notification bell now. And if you want to learn more about how you can buy, sell, and store gold and silver, log on to goldcore.com, your precious metals experts. Kevin Muir, welcome to GoldCore TV.
It's great to be with you today, Dave.
Now, we've seen an inflation number of 6.2% in the US, which is the highest number that we've seen in 30 plus years. Do you have faith in the Federal Reserve's ability to deal with inflation?
Well, I'd just like to back up and talk a little bit about inflation and what's driving it. And in the past, we've always assumed that inflation was driven by monetary policy. And the reason that we believe that is because prior to the great financial crisis, we'd actually spent the last 4 decades mainly making money through private sector credit creation. And ever since Volcker, broke the back of inflation, every time that there has been an economic downturn, what we've done is we've lowered rates to try to encourage more spending and more, private sector credit creation. What happened during the great financial crisis was that all of a sudden we couldn't lower rates anymore. They went to zero. And unfortunately, the private sector did not respond. We had what Richard Koo calls the balance sheet recession. And at that point, policy needed to change. And unfortunately, it didn't. It went, and what Bernanke did was quantitative easing and extraordinary monetary stimulus. And what that actually doesn't create real inflation, and we can talk about why that is, but I think that now everyone's accepted that. But back then, we didn't believe that that was the case. Back in 2009 and 10, when he was doing the quantitative easing programs, we actually had that open letter to Ben Bernanke, signed by many prominent economists and strategists about how that was going to create inflation. And it never did. Now, fast forward to the COVID crisis. The COVID crisis, we've understood that inflation is not created through quantitative easing, through monetary policy. It's mainly created through fiscal policy when you're stuck at this lower bound, meaning that you can't actually encourage the private sector to borrow anymore. So what you found was that we had a massive, massive fiscal push, the likes that we've never seen before. And this caught many people off guard in that they didn't think that we could create inflation. Remember back to March of 2020, there's lots of people that were talking about how the governments were hamstrung, that there was no way that they were going to be able to fix this. We were about to have a deflationary collapse because of COVID. And I kept saying in counseling, be careful. The governments can fill the hole. They can fill the hole with fiscal. And what's happened now is that not only have they filled the hole, they've actually piled an extra bit on top of it. And that's what part of the reason that we're experiencing the inflation that we're experiencing now. And so
this is all of the stimulus plans that we've had over the last couple of years now, and culminating now, we've got another 1.2 trillion.
That's correct. And so when you ask me, can the Federal Reserve continue to or control inflation going forward? It's not just the Federal Reserve that's part of the issue as we think about inflation. We need to realize that we've moved from an era of monetary dominance, meaning that we try to fix everything with monetary policy, to one of fiscal dominance. And with fiscal dominance means that we're going to see more and more spending and other kind of stimulus programs out of the federal governments throughout the world. And when I think about inflation, what scares me is that I look at it, and although I think we're about to get a little bit of a pullback on that fiscal stimulus, when I think about it over the next decades to come, there's been a change in attitude. The Carmen Reinhardt and the Rogoff book about this time is different and how we had to have austerity, those are all out the window. There's just no more thought about that. And so what we're seeing is more spending. So when I look at the dangers kind of going forward over the next few years, decades, to me, it seems that we've actually gone and created a government that is willing to spend And the difference is that in the past, we thought that we did all these quantitative easing, it didn't create inflation. And everyone thinks that we can do this as much as we want without creating inflation. And I argue, no, with this fiscal program, we actually can create inflation.
So what we need at the moment is fiscal discipline, and that doesn't seem to be on the cards at the moment.
No, you're right. And listen, one of the things that I always counsel is that we can sit around and talk about what we think is the optimal policy for our economy, our society. And there's lots of people that love to get on Twitter and give you their kind of opinions about it. And I say, who cares? Whether I think that this is the right policy or not is irrelevant. Whether you think it's, that we're having too much fiscal is irrelevant. What we're trying to do is figure out what is actually going to be done instead of what should be done, and then adjust our portfolios accordingly. And so to me, I look at it and say, yes, maybe we're going to have a little pullback of fiscal kind of restraint right now, because you see Senator Manchin talking about how the government's doing too much. And there's no doubt that we're going to get a pullback. But when I think about the longer term picture, it seems pretty clear to me that attitudes have changed. I see more and more millennials willing, voting being a bigger part of it. Everyone talks about how the boomers are so important to markets, but what a lot of people fail to realize is that even though the boomers own the majority of the assets and are actually the most important in terms of, influencing where the markets go, that when you look at the number of votes, actually millennials are the biggest cohort there is out there. There's more millennials than there are boomers right now. And up until now, they haven't voted, but I suspect that's about to change. And so I see a wholesale shift. I see a shift towards more fiscal for longer. And I look at it and say, we as human beings, we always take things to extremes. We took monetary policy to extremes. Like all you need to do is look at Europe and the disaster there with negative rates. Milton Friedman would be rolling over in his grave if he saw what, the extremes that was taken to. And I suspect on the other side of it, we're going to take fiscal to an extreme. And instead of arguing about whether it should be done, I just say it is going to be done, and make sure you adjust your portfolio accordingly.
So fiscal stimulus is here for the next while. So yes, we're going to see more inflation. Does the rate of inflation, like 6.2 is very high, does it get higher?
So I suspect that over the short run, it's going to go back down. I always get nervous whenever I see like inflation headlines on the top of the doom websites, the financial doom websites, and everyone agrees, with the fact that inflation is going higher. You saw Jack Dorsey talking, the CEO of Twitter, talking about hyperinflation. Markets have a way at this kind of, when you hit this hysteria of pulling back and correcting. So if I had to put my trader hat on, I would say that we're probably reached a momentary peak inflation. But I think when I'm thinking about inflation going forward for the next decade, there's not a chance that this was the top, not a chance. And I suspect that it's going to be much more elevated. One of the things that I just want people to understand is that if you look at what the market is signaling in terms of inflation, and you can do this through two methods. You can look at what's known as inflation swaps, or you can look at inflation break-evens. Inflation break-evens are in essence the difference between the yield on a nominal bond versus the yield on a bond that includes inflation, which is known as a treasury inflation protected securities. And a way you can deduct from the pricing of those is what the market expects inflation to be over the next little while. And if you look at it, even though we've had this inflation scare that everyone is really, really worried about it's been all at the front end of the curve. If you look at inflation swaps at 5 years, they're 310 or 320 or something like that. Meanwhile, if you go and look at a 30-year inflation swap, it's under 2.5. And that's only recently come up. For a while, it was stuck under 2%. Mm-hmm. And what that says to me is that the market is rightfully concerned that we're going to have a bout of inflation here, but yet they're not concerned over the longer term. And the reason that I think this is occurring is because, as I mentioned, we've had 40 years of disinflation, of bond rates going lower and lower and lower. Almost everyone that is managing bond money or fixed income money is only experienced lower and lower rates, and they've never had a period of sustained inflation. And I think about it, and I think back to 1982 or 81 when Volcker went and started to break the back of inflation with these higher rates and with his very tight monetary policy, and that ushered in a new kind of era of disinflation. And the interesting thing is, at that time, there was a fellow at Solomon Brothers, Dr. Kaufman, and he was known as Dr. Doom, and he just kept predicting more and more inflation, and it was. And he refused to change for the next decade. He just kept saying more and more inflation. Meanwhile, bonds just kept going lower and lower in yield, rising in price, and he was completely wrong. I suspect that when we look at the COVID crisis, that we will have experienced the same transformation that was in 1982 when Volcker broke the back of inflation, just in reverse. The COVID experience has ushered in the new era from disinflation to inflation. And for everyone that is sitting around looking at the inflation numbers saying this is transitory, it's going to come back down. Yes, it'll come back down probably for a little bit, but over the longer term, it's headed a lot higher.
So what's this mean for markets, and what's this mean for portfolios? How do we actually position our portfolios to take account of this?
Well, there's no secret. I love precious metals. Like I love gold. I love silver. I think we're going to have many years of financial repression with interest rates at negative real levels, meaning that the rate on the bonds will be significantly less than the inflation that we're experiencing. And I suspect that will be very, very constructive to gold and silver. And when I think about what's happened over the last couple of years with the advent of Bitcoin, we've lost a lot of money that would have more likely flown into these precious metals to those digital assets. And that's great. If you were smart enough to be long, terrific. That's great for you. But in the meantime, for the people that want something that's been around for a lot longer, that has a little more of, you can actually touch and feel and hold and store, I think that this has made the fact that gold and silver is probably cheaper than it should be at this stage. And I look at the sentiment that right now we're recording this early in November. I look at sentiment; it's bombed out on all the precious metals. I was telling some of my subscribers that I was buying gold, and even the bulls were giving me a hard time about it. And it reminds me of that Don Cox. Don Cox is a famous strategist that I believe worked for Bank of Montreal in Chicago, and he says that true bear markets are born out when those who love it best, those who know it best love it least because they've been burned the worst. And I feel like that's where we are with gold right now.
It's been a long road for a lot of gold investors to get to this point. And sentiment has been very low. Do you think then, obviously, that the audience for gold as such has narrowed as a result, and that one of the things that will drive it higher is as people as inflation starts people to understand more about the concept of sound money, as the money sitting in their savings account or on deposit is losing its purchasing power 6% at least over a year, and it turns them on to this idea of sound money and the role that gold and silver play as sound money.
I think that the problem is that we have a lot of those people have gone and they've moved to crypto. And so when I think about who are the next buyers of gold, I actually think it'll be more the traditional portfolio managers and the traditional other buyers. So I'm not actually as hopeful that we're going to see this mass move by retail into gold, at least not until crypto breaks. If it does break, who knows? It maybe never does. But one of the things that I'm thinking that will eventually happen in gold is that you will see a return by the central banks. And for those who don't follow what the central banks do, up until COVID, we were actually seeing central bank inventories of gold expanding quite, rapidly. Mm-hmm. We saw Russia and other, Eastern European countries buying lots of gold. And then when COVID hit, that pulled back. We got less of those buying. they're slowly returning to the market. And I suspect that before this is all through, that we will see a dramatic return from central banks to the gold market. And I suspect that that will be the true driver of the next rise. Because let's face it, gold is a small market for them, right? That is for a central bank that's used to moving around large sums of money. And also institutionally wise, it's just tiny. And I can't remember, Grant Williams had this great piece where he talks about if, and I think it was called If, or it was something of that, what if? And he argued that if you had all the pension funds in the world, if they just doubled their minuscule amount of gold that they held in their accounts, and he said something like, I can't remember the exact figures, but let's say it was 0.4% of pension fund money is in gold.
Yeah.
And he said if they doubled their number from 0.4 to 0.8, the amount of buying would be equivalent to all of the GLD and then some of the GDX, meaning some of the equities. And that's really what I'm thinking will drive the next rally is a wholesale change in attitude amongst institutional clients and also central banks.
So if you have that change, and it happens not necessarily on the retail level, but more on the institutional level and the central bank, and they're rotating into precious metals, what do you think that they're rotating out of? Is it primarily stocks, or is it bonds? Is it a combination of both? And what happens to those markets?
So my suspicion is it'll probably be bonds. I think bonds are a disaster waiting to happen for many people's inventory or accounts, investment accounts. Over the past 40 years, bonds have not only benefited from a huge decline in interest rates, but they've also had the added attraction of being negatively correlated with stocks, meaning that when stocks got into real trouble, your bonds would generally rally. And you have the likes of Ray Dalio at Bridgewater with his risk parity strategy, exploiting that in a huge way and creating an environment where they could lever up long stocks, long bonds to create a lower, volatility portfolio that did better. And when you see that relationship between bonds and stocks, when you look at it over many, many decades, you'll find that they're negatively correlated during periods of disinflation, but in periods of inflation, they become positively correlated.
Okay.
And if that were to be the case, then instead of bonds being the kind of ballast to your portfolio, to your equity portfolio, they might end up being the anchor to your portfolio. And so my suspicion is that a lot of people will find that the bond portion of their portfolio dramatically underperforms. It ends up, especially in real terms, getting crushed. And given that case, I suspect that you'll find them selling their bonds to buy gold. And if you think about how much bonds they need to sell, we just went over the kind of the percentage of their assets that are in gold. It's tiny. It doesn't need to be much for it to really move the needle on gold. And so what I would be watching for is that change in attitude when I discuss those swaps, those inflation swaps, and the fact that you saw that the front end is way higher than the long end in terms of inflation. I would be really, really mindful of when that starts to flip and you start to see people bidding up the price of long inflation and moving down the front end inflation. That will be the sign that I think gold is about to go nuts. Right. Because that'll be a change. You'll see a change in attitude. People will no longer think that it's transitory, and they'll start to be scared about long-term inflation.
And so we're talking there in that instance as well. You're talking about significantly higher bond rates.
So you need to be careful because yes, we probably will have higher bond rates, but there'll be different parts of the curve will be behaving differently. And there's no doubt in my mind that over the long run, the Federal Reserve will be very hesitant to chase the market higher. And so what you will see is a perpetual cheapness, lower rates at the front end of the curve that also creates a virtuous circle, making more inflation. They won't want to go and get ahead of inflation. And your original question, you said, do I have any faith that the Federal Reserve would be able to control inflation? They tell me that they can go at any time and stop inflation. And they're correct. They could go crank rates at the front end and put the economy into a recession and, stop inflation. But when I look at what they're signaling with their average inflation targeting and their changes in attitude about willingness to accept more inflation, again, all of the signs are that they're more comfortable with more inflation. It's both monetary and fiscal are both working towards higher inflation when you step back and think about it from a long-term perspective.
But if we do see higher yields and higher bond yields, that doesn't bode well for the US with the extent of the national debt either. They're going to want to keep a cap on rates.
So, Dave, I'm going to lose you a little here because I'm although I am not a full-fledged MMT fellow, there's a lot of it that I've actually come to understand and appreciate in terms of how the plumbing of the financial system works. And I for one, do not believe that there is ever going to be a funding crisis that way. I do not believe that's an issue. And so when I think about...
You don't believe it'll occur, or do you believe that they will be able to address it if it starts to raise its head?
I'm very hesitant to say that it'll occur. I look at Japan. They've been telling us for how long that Japan won't be able to fund itself. And Japan has gone from, what are they, 230% of the GDP is outstanding as debt. And that Rogoff book that I told you about, they told us that at 100%, the world ends and that they can't do it. And let's just take right now, like the COVID crisis. The COVID crisis showed that we didn't end up having a funding issue. What we ended up having was an inflation issue. And I truly believe that the real difficult part of the government navigating this kind of challenging period of this, there's no doubt we have lots of debt, and they have to inflate it away, and they have to inflate it away by having kind of higher prices throughout the board for a long period of time. I think that the challenging part will be keeping inflation in control, not the problems with a funding crisis. I don't think that that'll be the issue.
So the outcome is sustained long-term inflation.
That's correct. So I'll be the first to say that. And listen, I don't want to get too much into what should be done, but let's face it, there's too much debt out there. We need it to reset somehow. And if you think about how you reset debt, how do you do it? One way is you have an Austrian style, credit contraction. And when you think back to the great financial crisis, the private sector was trying to do that. They were trying to do, it had started, it was an implosion. And what was the result of that? The politicians in society showed you they have no time or willingness to go through that pain. So we can sit here and argue, if you get an Austrian an Austrian economist on, they'll tell you that this is the way that we have to do it. And I say, that's great. Maybe you're right. I don't know. But the reality is it's not going to happen. So why are we even arguing about this? I just don't see any signs that it'll happen. And if I saw society willing to go balance, like if there was a return of the Tea Party and people started arguing that, yes, you know what we need to do? We need to balance the budgets immediately. We need to go through a credit contraction and we need to reset all this, then I would change my tune. But that's not what I'm seeing. What I'm seeing is governments just willing to do more and more and more and more. And to me, that just means that we're going to have more of what we're seeing, which is higher inflation and more repression on interest rates.
So we've no fiscal discipline. Fiscal stimulus continues. and the Fed have no interest in standing in the way because it suits them and suits everybody, and as a way of inflating away the debt.
Right. And listen, they're going to mouth some words about being, prudent and working on and protecting the value of the money, but they're not going to do it. There's just no doubt about it. And I would argue that Powell in 2018, when he came over, he took over the chair at the Federal Reserve, and he looked at this and he saw what he thought were the beginnings of an asset bubble. And he said he gave many speeches during that period where he said, mopping up the problems of an asset bubble after they've burst are way worse than the cost of, slowing it down now. And if you look at a 2-year tip yield, which is the real rate at the short end, meaning the after inflation rate, you'll see that from Bernanke to Yellen, it had gone from a level of 50 basis points to minus 150 basis points, meaning the Fed continued to be extremely accommodative during that entire period. Powell comes immediately, the 2-year tip yield starts walking up as he raises rates, and you get a situation where he keeps doing it and keeps doing it and keeps doing it until it finally hits that point where he says, what was his line that he says? I can't even remember now. There was a famous line that he said, "We're a long way from neutral." That's it. He said, "We're a long way from neutral yet." And when he did that, the stock market just, it started to fall and it started to have real problems. And if you remember November and December of 2018, it was really ugly for the stock market till finally in that really ugly, pre-Christmas massacre, there was one day it was down 5% or something. Powell, tapped out and he said, "Okay, that's it. We're not a long way from neutral. I'll start easing again." And I would say that was the last central bank that will ever try. It's last central banker to ever try to be prudent. And I suspect that as you go forward, it's going to just be a question of how much do we accommodate it. And yes, there will be the occasional time when one central bank is slightly more hawkish, and there'll be little moments and periods where it seems like they're hawkish, but when it comes down to it, there's no atheists in foxholes, and I suspect that you're going to find that they're extremely easy for many, many years to come.
Do you think history is going to be kind to Jerome Powell?
Yeah, I think that it is. I'm not as fussed about inflation as many of the hard money guys are, and the reason I'm not is because I think the counterfactual is that if we'd gone and tried to balance books and do all sorts of other things, there would have been untold suffering. And I don't know if it really matters, but because as I say, we shouldn't worry too much about what should have been done. But everyone always is a backseat driver and has different opinions. And it's a very difficult job that he's doing. And I think he's a decent man that's trying to do the right thing. And he's looking at it. And one of the things that we haven't discussed, but if you look at the labor share of GDP versus the capital share of GDP over these past 40 years or 30 years, because it was slightly later that it actually kicked in, but labor share has been declining precipitously. Meanwhile, capital share of the GDP has gone up. And regardless of what you think is fair and just in this society, you have to look at what's happening in terms of the strife it's creating through the rising inequality. And so when I see labor starting to earn more and we see large increases in wages, I think that that's terrific. And I would love to see that trend continue.
So it's not necessarily going to come back into balance, but there might be a shift more towards labor.
That's correct. That's correct. I think that we're going to see much more much more winning at the expense of capital. Labor is going to win at the expense of capital. And one last thing, just, that we're talking all about this fiscal and everyone's focusing on fiscal. And I find it kind of funny because at the very moment that everyone's finally accepted that private sector credit creation no longer occurs and that the whole game is fiscal, we have a situation where the balance sheets of the consumer have never been greater. We go and look at and yes, it is uneven because unfortunately we shoved money out and it wasn't just the people who needed it. Other people got more money. And that's part of the reason that we're experiencing this euphoria and meme stock trading and all these other things. And I would argue crypto is one of those things as well. But when we look at their balance sheets, they've never been better. And so wouldn't it be ironic that just as everyone is focusing on fiscal and looking at the fiscal being withdrawn a little bit, meaning tamped down because they're getting scared, that we get private sector credit creation starting again. And the one thing you have to remember about private sector credit creation is that the private sector is actually much, much larger. So if you go and have all these millennials out buying houses, starting families, doing the things that create inflation, we might have some money supply growth and some economic growth that we haven't seen in a long, long time. And when I think about the risks of the next kind of few years, most people would argue that the risks is that we see a kind of a retreat, a falling back in terms of inflation and economic growth. And I think that they're greatly underestimating the possibility that what we see is actually a huge expansion to the upside, and we get massive growth that we haven't seen before.
It's been fantastic chatting with you today. How can the audience of GoldCore TV find out more about what it is that you do?
Sure. So I write a letter called The Macro Tourist. If you're interested in getting some copies, just send me an email, kevin@themacrotourist.com. You can also check out my website there, or you can look me up on Twitter @KevinMuir.
What I'll do is I'm going to link to all of those in the show notes and description below this video. But for now, Kevin Muir, thanks for joining us on GoldCore TV.
It's been a real pleasure, Dave. Thank you very much for having me.
Thanks for watching. And if you enjoyed this video, you'll definitely enjoy these interviews with some of the leading voices in financial markets and trading. And remember, as always, if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to GoldCore TV and hit your notification bell now. And if you want to learn more about how you can buy, sell, and store gold and silver, log on to goldcore.com, your precious metals experts.